Welcome back to this special MPC broadcast where we've learned that the Reserve Bank has decided to keep interest rates unchanged. So that means the repo rate remains at 7.5% and the prime rate at 11%. So I'm joined in studio by Mandisa Zavala. She's from AlexForbes. She's the head of asset allocation there. And via video link with Isaah Mhlanga. He's the chief economist at RMB. So let's start ladies first. Thank you very much for joining us, Mandisa. So the Reserve Bank governor talked about them actually reducing their inflation expectations for 2025. I think before it was somewhere in the region of 4%, somewhere there. Now they've reduced it right down to 3.6%. But despite that, they've decided not to cut rates. Please educate us as to why that is.
Yeah, I think at the start of the year, it was the market had been predicting that we'll probably see 2 rate cuts, and this would be the period in which we receive the second one. And I think as we've gotten closer and closer to this time, it's become a bit of a coin toss. And some of the reasons for that has been the global uncertainties. And it's interesting because in his speech the last time, he had already alluded to these global uncertainties. And despite that, we actually ended up cutting. What was interesting was the vote, where 2 members had already started to vote for a cut, and 4 were actually, 2 were voting for a hold, while 4 were voting for a cut. And so it was clear that the conversations around these global uncertainties and these risks were starting to seep into the conversations. And I think as well, when you look at a lot of his speech, he sort of emphasizes on these global uncertainties. And now it's sort of shifted where 4 members have voted for the hold, while 2 have been keeping to the cut. So I think despite the fact that even in the Q&A, he talks about the fact that right now inflation seems to be coming down, they have to look forward to the fact that going forward, there are some risks that might potentially put pressure. And I think that's essentially why we sort of ended up with, a speech where it seemed as though we were moving towards another cut, but at the end, they actually decided to hold rates. And it is that term, that balance of risks that they sort of allude to, that perhaps right now they need to sort of start to protect the future inflation, which we may not necessarily be seeing at this point in the short term.
Yeah. Isaah, are RMB's thoughts around the inflation situation, the global threats, are they aligned with what the Reserve Bank had to say today?
We have a slightly higher inflation forecast for this year at just over 4.1%. Perhaps that reflects the differences in our oil price assumptions, which are slightly above the Reserve Bank. But if you look in terms of the risks that the Reserve Bank highlights, which are, in our view, the primary reason for them being worried about the potential upside, risk to inflation, which are the tariffs that are currently being imposed by the U.S. administration across many countries. And potentially, if you add the implications of the VAT, which was announced at the budget, all of those, they pose upside risks to inflation. But the global risks in particular, they are the ones that are difficult to assess. And if you have, an inflation that is benign, lower than, 4% for this year, but if you look through your forecasting horizon, you see some increase that goes towards your midpoint. With all these uncertainties, it makes sense to sit tight and try to assess the incoming policies and the implications on your inflation before you make a move.
So Mandisa, what does this mean for consumers then?
I mean, consumers are not going to be happy because, according to them, interest rates are still on the higher bend. And I think in reality, everyone is looking at their pockets, especially now with the announced VAT increase. So people are essentially, assuming that it's going to be tough times going forward because we have this VAT number coming in. There are certain things that he pointed and alluded to, which is better fuel price projections, an environment where potentially we do have a stronger dollar. But obviously those again are, it's again a coin toss, and you sort of need to sort of balance that seesaw out. And I think in the consumer's bag, it does seem as though, things do become a little bit more on the tighter side, because you have no relief from a cutting perspective. But that being said, I think he sort of did speak to the fact that, it's almost like now he's handed the baton over to the growth dynamic and saying we are in charge of inflation. It's now time to sort of focus on some of the fundamentals and some of the programs that are spoken about even within the budget, which promote economic growth. So if anything, it's almost like that is the next thing that should sort of come into line to sort of relieve it. But to answer your question, it's definitely not going to be, kind of a sweet sort of thing to kind of take down.
Yeah. Isaah, just very quickly before we go for a quick break, what are your thoughts around the oil price? You talked about your sort of forecast being a little bit higher than the Reserve Bank. Where is that forecast, and what do you think you're going to see in terms of fuel prices in the country for the balance of the year, given the fact that, of course, the rand is, susceptible to changes on the global scene?
Look, as far as oil prices are concerned, we see the potential for increase in supply from the U.S. up to about 3 million barrels per day per the announcement from Donald Trump, who supports particularly drilling of, oil. And that might pose downside risks. But also, if there is a resolution as far as Ukraine is concerned, it might reduce some of the risks in the market. And then if you counterbalance to potential, roughly weakening trend in the currency because of the imposition of, the withdrawal of aid, but also potential loss of AGOA that we think potentially we are likely to see later in the year. And then you look at the positives, which would be likely, being removed out of the grey listing, potential improvement as far as our credit rating perspective later in the year. It just says to us there are a lot of risks both on the upside and on the downside as far as currency is concerned. The growth outlook as well has been moderating slightly relative to what we had expected earlier on, which was closer to 2%. Now we are at 1.7%, which is where the SAB now have growth as well. And so those vulnerabilities, the return of load shedding, even though it's not on a sustained basis, that again weighs on economic growth. So the fundamentals have weakened somewhat relative to what we had expected at the beginning of the year, which would pose some risk on the currency.
All right. Isaah, we're going to pause our thoughts there. Thank you very much for that comment. I'm in conversation with Mandisa Zavala. She's from AlexForbes, and Isaah Mhlanga from RMB. Thank you very much, both of you, for speaking to us. Isaah, let me just come to you and ask you about, you talked about AGOA and expecting that we might well lose it, given the sort of dialogue and discourse that's been had out there and the difficulties between the United States and South Africa at the moment. What sort of impact will that have on the economy if indeed that does happen, as we understand that the United States is quite a significant trading partner for South Africa?
Indeed, it will have an impact at the macroeconomic level. A loss of access of our exports to a significant market such as the U.S. is always a negative. You will always have a negative impact on our economy. It, however, accounts for less than 2% of our total trade. So it's not catastrophic at a macroeconomic level. However, if you look at some of the sectors that have access to U.S. markets under AGOA, it's concentrated in agricultural sector, particularly the citrus farmers and to an extent wine farmers. It's also concentrated in the automotive sector. So those sectors would potentially feel a bigger pain. So very high concentration to specific sectors, but at a macroeconomic level, even though it's negative, it's not catastrophic.
Now, Mandisa, the Reserve Bank governor talked about a number of different scenarios. He had sort of like a calm scenario and a not so calm scenario and a worst case scenario in terms of all the various things that could happen around global impacts. Now, one of the things he talked about was obviously the trade tariffs, the tensions that are there and the impacts that will have. At the moment, we don't have the threat of tariffs on us, but he talked about the possibility of us having tariffs on us and so on. So my question is, in the meantime, while we don't have those direct threats upon us, how would trade tariffs and inflationary impacts thereof then be transmitted into the South African economy for us to feel it?
So they did allude to this in the last MPC update. They ran scenarios, and in the extreme case, they'd actually come up with 10% tariffs universally, and if that were also counted with retaliatory tariffs by these nations. And they had actually pointed out that in this scenario, we would have an assumption, or they would come up with an assumption of the rand going back up to 21 rand, or all the way up to 21 rand. And then that would then cause inflation to go up to 5%. And they say that that would then imply that interest rates would need to go up by 0.5%. So obviously, given where inflation is at the current moment, having inflation back up at 5%, even though it is within that target range, is not something that the SARB would be comfortable with, and hence, the rate increase. And I think it does sort of put, a spotlight as to why they do note all of these global risks and tariffs as something to really watch out for, because they don't necessarily want to be on the back foot of this. And if this is what their scenario analysis is spewing out, they would rather be on the cautious side. So based on them, this would be the extreme scenario. And of course, having a rand at 21 rand would definitely not bode well for various reasons.
Not at all, not at all. Isaah, your comments around the possible global risk, aside from the AGOA issue, and how that may impact on the South African economy, even if we're not directly impacted by tariffs?
Look, most of the risks come from the U.S. policy perspective. If you just think about the tariffs, they generally reduce economic growth globally. There's already an increase in the odds for the U.S. economy to enter into a recession. Hence, you have seen the dollar start to weaken. And that at least would prevent the rand from depreciating aggressively if the dollar is weakening. So that provides some cushion as far as a weaker rand and the implications of the importation of inflation into the South African economy is concerned. So there is some sort of an offsetting mechanism from the tariff wars that are taking place. But in general, tariffs means an increase in prices to receiving countries. In this case, an increase in prices in the US, which would imply that the Fed is unlikely to cut rates as they were expected to, as long as the US economy does not experience a significant slowdown in economic growth. But if we were to see a significant slowdown in economic growth in the US, then growth becomes more of a binding constraint that might lead the US Fed to cut rates, which might also lead to a weaker dollar and a strong rand. That will reduce our inflationary pressures from an imports perspective.
We continue with our analysis of the Reserve Bank's decision to keep interest rates unchanged. I'm joined in studio by Mandisa Zavala. She's the head of asset allocation at AlexForbes, and via video link with Isaah Mhlanga. He's the chief economist at RMB. Isaah, let's just go through some of the recurring themes that the Reserve Bank governor always talks about towards the end of his speech. He always talks about real wage growth coming up in line with productivity gains, strengthening of network industries, prudent public debt levels, which I suppose he's speaking directly to the government, really, rather than ordinary South Africans. Just unpack all of that for us, because even in the area of administered prices, he's always saying, let's ensure that we have tempered administered prices, but they're always way over inflation. So why does he bring these up when he knows that the authorities don't really speak to it?
Look, I think it makes sense because there's always the temptation to ask monetary policy to do the heavy lifting for economic growth. But if you look at the tools that monetary policy has, they are quite limited and they're quite specific to fighting inflation or to maintaining inflation at stable levels and sustainable levels in the interest of balanced economic growth. but also it has to look after financial stability to make sure that the financial system is stable enough to encourage economic activity to take place. So that's the temptation that we tend to get from politicians or even the general public to say that the Reserve Bank should do more without actually recognizing the limited tools which they have. Much of the tools, they lie outside of monetary policy, which means that's where we need to see the adjustments. For instance, if we're talking about administered prices, that sits with National Treasury, that sits with government departments. It could be on the energy side with ESCOM and NESA. It could be the price of water that sits outside of the Reserve Bank. And all of those things, they're quite inflationary. If you look at the average prices on an annual basis over the last couple of years, or many years, in fact, they have been way above inflation. And that exerts upside risk to inflation, which means it's essentially a policy decision which parts of government have made to actually increase inflation, to increase prices at and above the targeted inflation rate, which the Reserve Bank has to contain. So essentially they're saying we have to reduce the pace of increase in administered prices so that it doesn't cause overall inflation to be above the target. And that already would limit the extent of how interest rate needs to be high in order to control this inflation. So it's a good call which the SAB is saying to government, assist monetary policy by not raising prices above the targeted level.
No, I hear you. And Mandisa, just in terms of structural reforms, because ultimately I think the biggest problem for us in South Africa is the lack of growth. And we have these structural reform processes in play in order to ensure, that we build more capacity for the economy to grow. How are we doing in that arena, do you think? And do you think that we're going to see a better picture for the economy a few years hence?
I mean, just to pick up off what Isaah said, within our economy or within South Africa, the MPC's role is inflation. But you have a committee like the Federal Reserve, which has a dual mandate. And in that mandate, some of the tools that they can use in order to drive within that dual mandate, it's of course inflation and also growth. They can lower interest rates or hike interest rates if the economy is hot. But they also have things like balance sheet loosening or tightening, or the purchasing of, we term it quantitative easing or quantitative tightening. So I think the point that Isaah made is definitely not one to take lightly in saying that their tool is quite limited. Now we get to the question that you're asking me to say, okay, what then are these different things that we're looking at or that they keep calling to, and is that working? And the answer is yes. I think there are certain areas, of course, that have started to, where we started to see a lot more activity. And one of those is also with, Transnet, which is also, a big contributor. If you were to bring that completely online, that would definitely contribute to growth. They speak about trade as well in the speech. Another one of those things was, or is electricity, right? The complete function of electricity. Of course, we still are experiencing power cuts here or there, but to a great extent versus what we had over the last a couple of years, we're actually in an environment where we wouldn't necessarily call it a crisis. We have electricity disruptions. And I think some of those things have been things that have been driven by government intervention, if you would put it, but also some of the reforms that Treasury has also spoken about. And so, yes, it is working, but definitely, there's always room to do better. And I think that's why, not to bring the VAT discussion back on the table, but that's why there was a lot of locking of heads between the different parties within the GNU, because some were calling for, let's actually focus more on growth rather than this VAT, because, there's a lot of things that are not functioning optimally that we need to actually fix. And that's the reality that we're facing, that there are some things that are contributing to some growth leakage, but some of it is actually, contributing to better I guess, not great growth, but better growth outcomes.
All right. Thank you so much, Mandisa, for that explanation. And to Isaah, thank you very much for your time and in your insights there. That was Mandisa Zavala. She's head of asset allocation at AlexForbes. And Isaah Mhlanga, he's the chief economist at RMB, just unpacking what came out of the Reserve Bank's speech today. They decided to keep rates unchanged, the repo rate remaining at 7.5% and the prime rate at 11%. With that, it's pretty much done from us, and Unati will be taking over the reins at 4 p.m. to give you more news.